And I think some of the topics that you and Joe just talked about, obviously play really well into this, especially when you're talking about planning for retirement, right? And as he was talking about, folks just living longer, like the longevity is a great problem to have, but it's definitely an investment problem we need to think carefully about. You look back over the last 40 years, and absent just the last few, we've had just this secular decline in bond yields, and you've had a real tailwind to the total return of bonds, right? So a lot of folks that are retiring today, like their entire investment experience over their working life from the early 80s on has been bonds are the place to be. And, as a result, you've seen, target date type funds get really popular. And as folks get older, the general way of thinking is, hey, I need to be more and more in bonds because I'm retired, I'm not working. I actually, just really don't agree with that thesis. And I'll tell you why. Just a couple key points. I mean, tactically in the short term, we definitely haven't seen bonds providing the diversification benefit that they used to, right? So they have not reliably been that safe haven that they were during that secular decline in yields for those 40 years. Also, when you just look at the yield curve shape right now, I mean, a 3-month yield and a 10-year yield is basically the same as we sit here today. And if you go out even longer on the curve, you get a tiny bit more premium, but wow, the volatility you get with that duration exposure is quite large. I mean, when you're looking at 20-year bonds and longer, I mean, this can be as volatile as the S&P 500.
Well, when I read your notes, and it was that you just said it, but this is what made me go, uh-oh. The 3-month yield and 10-year yield roughly the same. At what point do we get quiet intervention from the Fed or some other branch of government and try and change these yields? Because that's not sustainable, or is it?
Well, I think that from an investment perspective, there's a pretty big implication there, and I think you kind of just alluded to it as much. I think short term is probably where you should be putting your money when these things mature, not necessarily on the long end. We have seen the classic kind of term premium or the additional yield that long term bonds, that yield that they provide relative to the short term. We have seen that slowly tick up. I think some of the spikes we saw this year is probably for the wrong reasons, which is, concerns around budget deficits with, the tax bill that has made its way through the House. It's probably not the greatest reason to see that kind of move up. So we're going to want to see that move up for much more healthy reasons, which is, most notably just pure economic growth expectations. That would be a good reason for the long-term yields to move up relative to the short term. But look, I think the implication is why would you want to take on the additional volatility, which can be significant without the diversification benefits of the long end, when you can stick to the very, very short end of the curve, which honestly provides a lot of liquidity opportunities for you as well if there is market pullbacks, which we've definitely seen a lot of that headline-driven volatility this year.
I don't know the true expression. I'd rather be lucky than right. I got very lucky because I did not realize what we were doing when we were doing this short-term play with treasuries, but it worked out well. But now the question I have is high-yield corporate bonds. Is that something? I mean, what should the horizon be on that? And it clearly comes with some risk. I mean, I'm just going to throw out a hypothetical here. Buddy of mine just got walking papers from Paramount Global. They're laying off staff. There's a huge debt load they've got to deal with. And this individual is telling me, people are talking about bankruptcy. I don't know what's going to happen with Paramount. But corporate debt, that evil genie's out there sometimes. So is high yield bonds, is it only corporate debt I should be looking at? Where else could we look?
Well, when I think about the broad bond universe, I mean, you're talking about the short-term cash, like, treasury, money market, bill, those investments. I would lump investment grade bonds, treasuries, mortgage-backed securities, all of that investment grade stuff into a bucket. And then, you have the high yield kind of corporate market. Right now, like I like the two ends. I don't really like the middle because of that duration exposure. Now you look at high yield spreads, and they actually are below where we were just slightly, pre-Liberation Day. At first glance, you might scratch your head a little bit and say, well, have we really priced all of that risk out of the market? But those spreads being 300 basis points with the, a solid economic backdrop, provides you a solid yield. I think the high yield asset class overall has actually been, an incredible risk return trade off. I mean, you're able to get the 7 to 8% all in yields with volatility that's roughly 20 to 25% of that of the equity markets. I mean, even in this recent pullback we had, yes, high yield bonds pulled back about 4.5% compared to
Mm-hmm.
the 20 in the S&P. And of course, they're going to have some of that, kind of equity beta, equity risk exposure. But on just a pure risk return trade off, that has really been a very, very strong play. And I think as long as a recession is kind of not in the cards and in your thought process, I do think that's a good place to clip some coupons and earn a quite attractive yield, again, above inflation, which is what we really want. And the economic data has been strong.
Yeah, the jobs are holding up. Inflation is seems to be under control,
Yep.
which all of those things are lining up appropriately. Last question on bonds, and then I want to get into what sectors you like.
Yep.
But I talked with the last guest. I was talking with Joe about risk-free, U.S. Treasuries. Does anyone really care? Do investors care that we just got downgraded? U.S. debt, and does anyone take, because we have not passed the tax bill yet, and I'm hearing people on television, and I used to be on TV, so trust me, don't believe people on TV, talking about doom and gloom if we pass the tax bill. Do the investors care about the debt load that the United States is carrying?
Well, I mean, I guess you asked a couple questions there, but overall, when we look at potential debt burden, I mean, over the long term, of course, that would be a problem. But at the same time, if you can spur economic growth and kind of make up for some of that loss in revenue, then that's going to really be the trade-off. Certainly something to worry about.
Mm-hmm.
But at the same time, that's why we have all these economic data releases. We're going to be able to track this stuff in real time, and and see what the ultimate impacts are.
All right, so let's turn to equities. What sectors should people be following? Because most of us, those of us who are not professionals at this, we get all excited with the Mag 7. I mean, Tesla, Elon Musk is puckering up and kissing what, and seems to be back on the upswing. But forget the Mag 7. Where should we be looking?
Yeah, look, I think one place that has been relatively, overlooked and is really a great entry point at this point is the small mid cap space here in the U.S. So there's a lot of household names, kind of in that space that I think folks would be, surprised to hear of. But at the same time, when you're looking at just broad asset class exposure, those areas of the market have really been tempered in their overall returns due to rates kind of being high and certainly not coming down in a hurry at all.
Mm-hmm.
Your smaller mid-cap companies will tend to have a little bit more sensitivity just from a cash flow to debt service type of ratios. And so they have over the last couple of years been quite sensitive to the higher overall level of rates. And as where we sit today, I mean, they're still negative on the year, well below large cap stocks. I think that makes for a great entry point for several reasons. One, I mean, you've definitely seen some broadening out in earnings growth and earnings breadth in those markets. And that's, of course, going to be extremely helpful over the long term, where just with inflation this morning, right? I mean,
Mm-hmm.
Fed hikes are certainly nowhere in the conversation. But you go back 6 months and you couldn't necessarily say that.
Right.
So I think you've got a slight downward bias in yields, although I don't think that it's going to happen in a hurry. And then just look at the overall administration's policies. They're very domestic focused. A lot of this tariff drama is not going to impact very much some of the more domestic and smaller companies that are really insulated from that because they're not doing business overseas.
But
And the deregulatory backdrop as well, I think, is going to be very helpful.
Well, let's talk about, so the Russell 2000 is off, what, 3.5% year to date. Doesn't that usually mean we're lining up for a recession, or do we need to, the past is not indicative of what's going to happen in the future? And even though it's down, you talk about an entry point within the Russell 2000. Should I be looking at software companies? I mean, is there any one particular venue you would direct my attention to?
I think consumer focused areas would be one kind of subcategory in the small mid cap space, just given the resilience of the consumer and the resilience of the labor market. Of course, that's going to be the dominant driver in GDP growth. And I think a lot of the policies that are in process here, the goal is to boost that tremendously. I think that would be a great place to look for. I think also if you want to get really into the weeds, thinking about the AI theme. Okay, so
Mm-hmm.
this massive productivity enhancement technology, I think we've kind of moved on from that being just about semiconductors, and we're kind of moving on to a phase where, hey, where can I find companies that are actually able to make these huge productivity enhancements that are going to fall to the bottom line? And I think that there's a lot of companies, a little bit, underneath the surface a little bit in that small mid cap space that could be really poised to take advantage of these types of technologies. And, software and services type companies, I think would certainly fall into that category and would be a great place to look for in the small mid cap space to get advantage of, again, some of this kind of cyclical economic setup that I'm talking about, but also take advantage of this AI narrative, which is going to be a dominant theme for a while, especially as this technology continues to mature.
We have some deadlines out there: July 9th, we have August 12th. It's clear that the Trump administration, I know those opposed to President Trump will make fun of the back and forth with tariffs. Those in favor of President Trump will tell you that's the negotiating strategy. How do you make heads or tails of this, or does it not really matter that we have these deadlines looming?
I actually don't really think it matters. I mean, you heard Besant today who was talking about how if countries are actively making good progress towards negotiations, like the plan is to just push the deadline out. And it's interesting. I mean, even just looking at the very very short term, the market reaction this morning, right? There's headlines before markets open about this deal that's in place with China. It's a great deal. Something that, quite honestly, I saw the headline. I come into sit down at my computer. I expect to see stocks up a lot,
Mm-hmm.
and barely budged. And of course, we didn't even hardly, we went nowhere on the entire day. And I think that's really telling. I mean, just looking at that price action, I think the market's getting a little tired of the back and forth tariff conversation. I think the market's in the process of moving on, honestly. Over the course of the last couple months, I think Trump's made it very clear that this is a negotiating process, this is a negotiating tactic. I don't think he's going to hold the market hostage at all costs, and the market knows this. And I think most of that's in the price. So I don't think that these deadlines are going to be as big of a deal as we might have thought they were initially, and it's very likely that you're just going to continue to see things get pushed out, and
Mm-hmm.
over time we'll get developments, but there's just a lot less sensitivity, I think, to that right now than, of course, there was, back in early April.
Okay, and last question for you. What's the headline you're watching?
The headline I'm watching right now, I think, is just really going back to the fundamentals. So, I think about what the market, what's the next big theme going to be, right? Is it,
Plastics.
I think the market's moving on a little bit from tariffs. The Fed really kind of out of the picture right now. The economic data has been pretty solid. I think it goes back to company earnings, and I think it goes back to us watching for how these massive technologies like AI can penetrate these sectors and and companies, and really seeing where that's making a big difference. Because I do think you are really going to see some big winners that make really good use of these technologies. And so I think it goes back to seeing how that flows through to the company earnings.